Fort Knox exists less as a place than as an idea. Ask someone what backs the US dollar, and even decades after the gold standard ended, many will still answer with the same image: a massive granite fortress in Kentucky, guarded by soldiers, holding the wealth of the nation in silent, stacked bars of gold. Fort Knox is not just a vault. It is a psychological anchor. It reassures markets, allies, and citizens that somewhere, beneath layers of concrete and steel, America's financial power is real, tangible, and immutable. The facility, formerly known as the United States Bullion Depository, was constructed in 1936 and became operational in 1937. Its creation was not about security alone. It was about control. 2 years earlier, in 1934, President Franklin D. Roosevelt signed the Gold Reserve Act, following Executive Order 6102, which forced Americans to surrender most privately held gold to the government at a fixed price of $20.67 per ounce. The Treasury then revalued gold to $35 per ounce, effectively transferring purchasing power from the public to the state overnight. By centralizing gold ownership, the U.S. government gained the ability to expand credit and manage the monetary system with far fewer constraints. Fort Knox was built to store this newly consolidated hoard. By the early 1940s, the United States controlled roughly 75% of the world's official gold reserves. During World War II, gold flowed into the U.S. from Europe as nations paid for weapons, food, and industrial supplies, or simply sought safety from advancing armies. By 1945, America was not just a dominant industrial power, but the dominant monetary power. Fort Knox became the physical symbol of that dominance. At its peak, the depository reportedly held over 649 million troy ounces of gold. Today, the official figure is approximately 147.3 million ounces, equivalent to about 4,580 metric tons. At current market prices, that gold will be valued at roughly $300 billion. But this number itself reveals the first crack in the story. Even at record prices, Fort Knox's gold would not come close to backing the U.S. monetary system. M2 money supply in the United States exceeds $20 trillion. Federal debt is over $34 trillion. The gold, even if fully present and unencumbered, is symbolic rather than functional. Yet symbols matter. After World War II, the Bretton Woods system formalized this symbolism into a global structure. The US dollar became the world's reserve currency, convertible into gold at $35 per ounce for foreign governments and central banks. Fort Knox, along with other depositories like West Point and Denver, became the implied guarantor of the entire system. Nations did not need to see the gold. They only needed to believe it was there. For a time, belief was enough. But belief depends on credibility, and credibility depends on verifiability. That is where the Fort Knox story becomes uncomfortable. Despite its central role in the global monetary imagination, Fort Knox has never undergone a full, independent, modern audit in the way financial institutions are routinely audited today. The last comprehensive examination of the gold reserves occurred in 1953, 70 years ago, under the Eisenhower administration. That inspection did not involve the kind of procedures one would expect today: no continuous chain of custody review, no independent international auditors, no systematic assaying of randomly selected bars to verify purity and weight. It was conducted internally, during a period when the US still operated under a gold-linked system and had every incentive to preserve confidence. Since then, what the public has seen are gestures rather than audits. In 1974, following growing skepticism in Congress and among the public after the Nixon shock in 1971, a group of journalists and politicians were allowed to tour a small portion of the facility. They saw gold. Photographs were taken. The message was clear: trust us. In 2017, Treasury Secretary Steven Mnuchin visited Fort Knox and tweeted that the gold was safe. No inventory report followed. No independent verification was released. The visit functioned as reassurance, not evidence. To understand why this matters, it is important to recognize what Fort Knox actually represents. It is not merely a warehouse. It is a keystone in the architecture of trust that underpins us financial credibility. The US Treasury officially states that it owns the gold held at Fort Knox, valuing it on its books at $42.22 per ounce, a relic price set in 1973. This accounting choice alone should raise eyebrows. The gold is not marked to market. Its real economic value is ignored in official balance sheets, while its symbolic value is emphasized in rhetoric. This disconnect points to a deeper truth. Fort Knox is no longer meant to function as an operational monetary reserve. It is meant to function as a narrative anchor. The idea of vast, untouched gold reserves reinforces a perception that the US dollar rests on a bedrock of historical strength. Even though the system has long since moved to pure fiat currency backed by debt issuance and military, political, and institutional power. That distinction between narrative and reality is crucial. In finance, perception often moves markets more effectively than facts. Central banks understand this. Governments rely on it. Fort Knox's role is not to be used, audited, or even discussed in detail. Its role is to exist unquestioned in the background of global finance. But history shows that symbols without transparency eventually fail. Every major monetary collapse has been preceded by a gap between what people believed and what was actually true. In the late Roman Empire, coins continued to bear imperial imagery, even as their silver content collapsed. In pre-revolutionary France, the monarchy projected stability, while the Treasury emptied. In 1971, the US claimed dollar convertibility long after it had become mathematically impossible. Fort Knox sits uncomfortably in this tradition. The stronger the symbol, the more dangerous it becomes to verify it, because verification introduces risk. If an audit confirms everything, little changes. But if it raises questions, the consequences would ripple far beyond a single building in Kentucky. Confidence in Treasury debt, the dollar, and the post-1971 monetary order itself would come under scrutiny. That is why Fort Knox is treated differently from every other critical financial institution. Banks are audited. Public companies are audited. Even foreign central banks storing gold abroad increasingly demand repatriation and verification, as Germany did beginning in 2013 when it requested a return of hundreds of tons of gold from New York and Paris. Yet the core reserve of the world's dominant financial power remains shielded from the same standards of transparency. Part 1 ends with a simple but destabilizing observation. Fort Knox is not protected primarily by walls, weapons, or secrecy. It is protected by belief. And belief, once questioned, is far harder to defend than gold. If Part 1 exposed Fort Knox as a symbol rather than a functional monetary reserve, Part 2 examines a distinction that makes that symbolism possible in the first place, the difference between ownership and location. In modern finance, what you can see is rarely what you actually own. And nowhere is that gap more important than with gold. Most people assume that if gold is physically stored in a vault controlled by the US government, then that gold is unquestionably owned, unencumbered, and available. But finance does not work that way. Location tells you where an asset sits. Ownership tells you who has the legal claim. Those two concepts can diverge completely. And when they do, physical presence becomes almost irrelevant. Officially, the gold store at Fort Knox is owned by the US Treasury, not the Federal Reserve. This distinction is often misunderstood, but critical. The Federal Reserve does not own gold. It holds gold certificates issued by the Treasury as assets on its balance sheet. These certificates are valued at the statutory price of $42.22 per ounce, a number frozen in time since 1973. In other words, the Fed's gold asset is not gold itself, but a paper claim on gold owned by the Treasury, priced at a level that bears no resemblance to reality. Already, this structure should raise questions. Gold is treated less like a reserve asset and more like an accounting artifact. The physical bars exist somewhere, but the system that references them operates entirely on paper. And paper claims can be multiplied, layered, and abstracted in ways that physical gold cannot. This abstraction is not unique to the United States. It is the foundation of the post-Bretton Woods monetary system. After 1971, when President Nixon suspended dollar convertibility into gold, gold ceased to function as money and became a reserve asset of last resort. Central banks still held it, but it no longer anchored currency issuance directly. Trust replaced convertibility. And once trust becomes a mechanism, transparency becomes optional. To see how ownership and location diverge, consider foreign gold held by the United States. For decades, countries such as Germany, Italy, the Netherlands, and others stored large portions of their gold reserves abroad, primarily at the Federal Reserve Bank of New York. The rationale was practical. New York was a global financial hub, and gold stored there could be mobilized quickly in international settlements. But this arrangement also required absolute trust that the gold was untouched, unencumbered, and immediately retrievable. That trust began to erode after the 2008 financial crisis. In 2013, Germany announced that it would repatriate 674 metric tons of gold from New York and Paris. The process was slow, taking several years, and the explanations offered were vague. German officials insisted there was no concern about availability. Yet the fact remains, a country with one of the most sophisticated central banks in the world felt the need to physically reclaim its gold. Location suddenly mattered again, because ownership without control had started to feel insufficient. This episode highlighted an uncomfortable reality. When gold is stored in someone else's vault, you rely not on law alone, but on politics, diplomacy, and stability. In a crisis, legal ownership can be overridden by emergency measures, capital controls, or geopolitical pressure. History provides plenty of examples. Gold confiscations, frozen assets, and suspended convertibility are not anomalies. They are standard responses to systemic stress. Now bring this logic back to Fort Knox. The U.S. Treasury claims ownership of the gold, but ownership in modern finance does not necessarily mean exclusivity. Gold can remain physically in place while being pledged, leased, or otherwise encumbered. No forklift needs to move. No door needs to open. The gold can stay right where it is while its economic function changes entirely. This is where the accounting treatment becomes revealing. The Treasury does not mark its gold to market. It does not disclose detailed bar lists publicly. It does not provide regular, independent verification of encumbrances, leases, or swaps. Instead, it reports a static number and relies on continuity of belief. As long as markets accept that number, the system holds. But markets have learned repeatedly that reported numbers and economic reality often diverge. During the 2008 crisis, banks reported capital ratios that later proved meaningless once off-balance sheet liabilities were accounted for. In the European sovereign debt crisis, governments reported debt levels that excluded vast contingent obligations. The lesson was clear. What matters is not what is reported, but what can be enforced under stress. Gold ownership faces the same test. In calm periods, paper claims are treated as equivalent to physical possession. In crises, they're not. That is why sophisticated investors distinguish between allocated and unallocated gold, between physical bars and pooled claims, between custody and ownership. These distinctions exist because history has punished those who ignored them. The uncomfortable question, then, is not is there gold at Fort Knox. It is what legal and financial claims exist against that gold. And on that question, transparency is minimal. This opacity did not arise by accident. It is a feature, not a bug. The modern monetary system depends on flexibility. Gold, if treated as a fully transparent, fully audited, unencumbered asset, would impose constraints. It would limit leverage. It would expose mismatches between claims and reality. By keeping gold in a symbolic role rather than an operational one, policymakers preserve freedom of action. Fort Knox's power lies precisely in its ambiguity. It is real enough to anchor belief, but distant enough to avoid scrutiny. Its gold is assumed to be there, assumed to be owned, assumed to be untouched. Each assumption supports the next. Together, they form a closed loop of confidence. Yet confidence built on assumption is fragile. When systems come under pressure, participants stop accepting abstractions and start demanding specifics. They ask who owns what, where it is, and under what conditions it can be accessed. That moment has arrived before in monetary history, and when it does, the difference between ownership and location becomes decisive. Part 2 ends with a shift in perspective. Fort Knox may indeed hold gold. The vaults may be full. But in modern finance, that is the least important question. The critical issue is whether physical presence still guarantees uncontested ownership. And once that question is asked seriously, the solidity of the entire narrative begins to weaken. By the time the discussion reaches gold leasing and rehypothecation, the Fort Knox question stops being about secrecy and starts being about mechanics. You no longer need conspiracy theories or missing vaults. You only need to understand how modern financial systems treat collateral. Because in that system, a single asset can quietly support multiple claims at the same time. Gold leasing is the first layer. At its simplest, gold leasing occurs when a central bank lends physical gold to a bullion bank for a small interest rate, often well below 1%. On paper, the central bank still counts the gold as a reserve asset. In reality, the gold has left its direct control. The bullion bank typically sells the borrowed gold into the market, receiving cash, which it then invests in higher-yielding assets. The spread between the low gold lease rate and higher market returns becomes profit. This practice expanded dramatically in the 1980s and 1990s as Western central banks sought ways to mobilize what they considered to be a sterile asset. Gold sitting in a vault produced no yield. Leasing turned it into a productive financial tool. By the late 1990s, estimates from institutions like the Bank for International Settlements suggested that thousands of tons of central bank gold had been leased into the market. Crucially, much of this gold continued to be reported as part of official reserves. From an accounting perspective, this made sense within the system's own logic. The central bank had a claim on the bullion bank, and therefore still owned the gold. From a physical perspective, however, the gold was gone. It had been sold, refined, shipped, or fabricated into bars that now sat in private vaults or jewelry markets across the world. To get it back, the bullion bank would need to repurchase gold from the market in the future. That requirement introduces the second layer of risk. If many central banks demand their gold back at the same time, the bullion banks must source physical metal in a market where supply is limited and prices would likely spike. The system functions only as long as redemption remains theoretical. Rehypothecation takes this logic further. Rehypothecation occurs when collateral that has been pledged for one obligation is reused to secure another. In plain terms, the same gold supports multiple promises. This is not illegal. It is standard practice in modern finance, particularly in derivatives and wholesale funding markets. In the gold market, rehypothecation means that one physical bar can generate numerous paper claims. Futures contracts, unallocated accounts, swaps, and options all reference gold without requiring the movement of metal. The London Bullion Market Association, LMA, the core hub of global gold trading, operates primarily on an unallocated basis. According to LMA data, daily trading volumes often exceed global annual mine production by many multiples. This is possible only because most trades settle in cash, not metal. The implications are profound. The effective supply of gold in the financial system is not determined by how much gold exists, but by how many claims are accepted as equivalent to gold. As long as participants are content to roll positions and accept cash settlement, the illusion holds. Physical scarcity is masked by financial abundance. This is where Fort Knox re-enters the picture. The gold in us vaults does not need to move to be functionally involved in this system. It can serve as implicit backing for leasing arrangements, swaps between central banks, or confidence in the broader paper gold market. Even if Fort Knox gold has never been directly leased, its existence underpins the credibility of a system that relies on the assumption that enough physical gold exists somewhere to honor claims if necessary. But assumptions are fragile. In 2008, financial markets learned that rehypothecated collateral could vanish when counterparties failed. Lehman Brothers collapsed with rehypothecated assets scattered across balance sheets worldwide, leaving clients unsure which assets they actually owned. Gold operates under a similar logic, except the opacity is even greater. The ratio of paper gold to physical gold is not precisely known, but estimates commonly range from 50 1 to over 100, 1 in major trading centers. This means that if even a small fraction of claim holders demanded physical delivery simultaneously, the system would break. Prices would surge, contracts would be cash settled, and the distinction between owning gold and owning a promise would become painfully clear. Central banks understand this dynamic. That is why gold rarely moves. That is why audits are limited. Movement creates records. Records create accountability. Accountability creates constraints. A static pile of gold, referenced but untouched, is far more useful to a leveraged financial system than an actively verified reserve. Fort Knox, in this context, becomes less a vault and more a keystone of confidence. It reassures markets that somewhere, beyond the reach of day-to-day trading, a vast stock of gold exists. Whether that gold is encumbered, leased, or pledged is a secondary question that few are encouraged to ask. The critical insight is this: gold does not need to disappear physically to lose its economic function. Once it is leased, swapped, or rehypothecated, it becomes part of a web of claims that can never all be satisfied at once. The metal may still sit behind a steel door, but its financial identity has been diluted. By the time this process is understood, the Fort Knox debate shifts entirely. The question is no longer whether the gold is there. The question is how many times it has already been promised. Part 3 ends on that realization. In a system built on leverage and trust, gold is not the anchor people imagine. It is the collateral quietly stretched until it can no longer bear the weight placed upon it. The question that naturally follows everything so far is simple. If Fort Knox matters so much, why has it never been properly audited, not visited, not photographed, not ceremonially inspected, audited? The kind of audit that would satisfy the standards applied to banks, corporations, and even small public institutions. Independent, comprehensive, repeatable, and focused not only on quantity, but on ownership, encumbrance, and chain of custody. The official story is that audits have happened. The reality is that none of them meet modern definitions of the word. The most frequently cited inspection took place in 1953 under President Eisenhower. Treasury officials examined the gold and reported that the reserves were present and accounted for. But this was a different era under a different monetary regime. The dollar was still linked to gold. International convertibility was still official policy. The United States had overwhelming industrial dominance and minimal external pressure. Trust was not scarce. It was assumed. More importantly, that inspection was internal. There were no independent auditors, no international observers, no publicly released bar lists, no random assaying of bars to verify purity, and no examination of legal claims or encumbrances. It confirmed that metal existed, not that it was unpledged, uncontested, or economically available. Since then, what the public has been shown are symbolic gestures. In 1974, following years of growing skepticism after the Nixon shock, a small group of journalists and members of Congress were allowed inside Fort Knox. They saw stacks of gold. Cameras rolled. The message was reassurance, not verification. Seeing gold behind glass is not an audit. It proves presence at a moment in time, nothing more. In 2017, Treasury Secretary Steven Mnuchin visited Fort Knox and declared that the gold was safe. Again, no documentation followed. No inventory reconciliation. No third-party review. No explanation of accounting treatment, leasing, or swaps. It was a statement designed to close a conversation, not open one. To understand why this pattern persists, it helps to imagine what a real audit would entail. It would require a complete physical inventory of all bars, matched against detailed bar lists. Random samples would be assayed to confirm weight and purity. Chain of custody records would be examined to identify whether any bars have been moved, swapped, or replaced. Legal documentation would be reviewed to determine whether any gold was leased, pledged, swapped, or otherwise encumbered. The process would be overseen by independent auditors with no institutional stake in the outcome. That level of scrutiny would answer questions policymakers prefer to leave unasked. If the audit confirmed that all gold was present, unencumbered, and fully owned by the Treasury, the immediate economic impact would likely be minimal. The gold would still not back the dollar. The monetary system would not change overnight, but the precedent would. Transparency would become expected, not optional. If, on the other hand, the audit revealed complications, leases, swaps, missing documentation, or overlapping claims, of consequences would be severe. Confidence in us financial reporting would be damaged. Questions would arise about the role of gold in central bank balance sheets globally. Markets would begin to reprice not just gold, but trust. This asymmetry explains the incentive structure perfectly. A clean audit offers little upside. A problematic audit carries enormous downside. Rational actors avoid asymmetric risk. So the audit does not happen. There's also a deeper, structural reason. The modern financial system is built on managed opacity. Sovereign debt markets, central bank swap lines, off-balance sheet guarantees, and emergency facilities all rely on selective disclosure. Full transparency would constrain policy flexibility. It would limit the ability to respond to crises with improvisation. Gold, with its rigid physicality, is an awkward fit in such a system. That is why gold is kept symbolically powerful but operationally dormant. It is referenced, not used, counted, not examined, defended rhetorically, not demonstrated empirically. The contrast with ordinary financial institutions is striking. Commercial banks are audited annually. Public companies face quarterly reporting requirements. Even small discrepancies can trigger investigation, fines, or loss of market access. Yet the core physical reserve associated with the world's reserve currency remains effectively exempt from these standards. This exemption is often justified on national security grounds. Fort Knox, we are told, must remain secret to remain safe. But secrecy and audit are not opposites. Nuclear weapons facilities are audited. Military procurement contracts are audited. Intelligence budgets, while classified, are still subject to oversight. Security explains limited disclosure, not the absence of verification. The more plausible explanation is that Fort Knox performs its function best when it is not examined too closely. It anchors belief precisely because it exists in a liminal space, real but distant, known but not measured. Once you apply the same analytical tools used elsewhere in finance, the narrative becomes fragile. History offers a consistent lesson here. Monetary systems fail not when assets vanish, but when confidence does. In 1968, the London gold pool collapsed not because gold disappeared, but because demand for physical delivery overwhelmed paper promises. In 1971, the US did not run out of gold. It ran out of credibility. Foreign governments no longer believed convertibility claims could be honored. Fort Knox is protected from this fate by avoiding the conditions that would test it. No redemption, no audit, no confrontation between paper and metal. That is why the title, The Audit That Will Never Happen, is not rhetorical exaggeration. It is a description of incentives. The system has evolved in a way that makes certain questions unaskable, not illegal, not forbidden, simply too destabilizing to pursue. The final irony is this. If Fort Knox truly contains exactly what is claimed, fully owned and unencumbered, an audit would strengthen trust. The refusal to conduct one does the opposite. It invites speculation, doubt, and alternative narratives. It turns a supposed pillar of confidence into a quiet source of unease. And that brings the story full circle. Fort Knox began as a solution to a trust problem. It centralized gold to stabilize a monetary system under strain. Today, it persists as a monument to a different kind of trust maintained not through proof, but through tradition and silence. The gold may be there. The vault may be full. But in modern finance, what matters is not what exists, but what can be proven under pressure. Fort Knox has never been tested that way. And as long as the system depends on belief more than verification, it likely never will be.